there's a potential to really bring down your tax if you can follow a couple of rules. So,
Hi, I'm Bette Hochberger, CPA, CGMA. This channel aims to educate you on tax, tech, crypto, and finance related news. Come learn how to grow and keep your wealth.
today we're going to talk about avoiding real estate tax mistakes. So, if you've ever gotten involved in real estate and you didn't have like top notch tax guidance, this is for you, right? You can avoid a lot of mistakes in real estate taxes. And let me tell you that real estate tax is no joke. It's complicated. There's a lot of rules, there's a lot of regulations. It's not like, when you just have a W 2 and you can just file your taxes on your own. I mean, I see plenty of people try to file their taxes on their own, but it's hard. It's a hard one to do right, and it can be fraught with errors. So, we're going to try to help you here avoid some of these mistakes, okay? So, capital gains taxes. Let's start there. When you buy and sell real estate, you are largely dealing with capital gains taxes. And the thing that's great about that is there's a potential to really bring down your tax if you can follow a couple of rules. So, number one, hold it for more than 1 year. Your holding period really, really, really matters, right? Less than 1 year, short term, more than 1 year, long term. Super important understanding that, because I've seen people get walloped by like just a couple of days, right? So, got to keep an eye on that. Sometimes you can't let the tax tail wag the dog, but when you can, when you have control over it, you really, really, really have to pay attention to dates. So understanding how those capital gains taxes work, super, super important. Also, along that same line, 1031 exchanges. I know people feel like they're um, this really like, oh, let me just do a 1031, right? Like people all the time, like, oh, I'm just going to do a 1031. They're complicated. They're not this easy tool. They're a powerful tool, but they have a lot of rules, right? And this is also an area that's going to affect capital gains taxes. This next one, I think, is probably the biggest mistake that I see people make all the time in with rental properties, all the freaking time. Overlooking deductions, right? If you're not keeping good records, if you don't know what you're spending, it is very easy to miss out on deductions for your rental property. And I see it all the time. I've had clients where we're doing their tax return, and here's a little pro tip: compare what you did last year to this year, or this prior year to the year before that, really, when you're doing taxes. And the reason is sometimes you'll see something that you forgot. I cannot tell you how many times I've had clients where I'm like, especially here in Florida, did you have property insurance? Yeah, it's expensive. Deduct it, right? If you've got insurance on your rental property, make sure you deduct it. But it goes for everything. Whatever you have that you're paying for that property, make sure you're including it. Don't miss out on any of those tax benefits by ignoring deductions. Ignoring depreciation recapture. Okay, depreciation recapture is really a whole video unto itself. It's probably more than one. But if you're selling your property, you have to take depreciation recapture into consideration, right? It's something that you need to look at. I know everyone loves to do like cost segregation studies and things like that, but take a look at what the depreciation recapture is going to do to your taxes when you sell. Incorrectly reporting rental income. Um, you know, anytime you do something wrong on your taxes, you're inviting the IRS in, right? So you want to make sure you're reporting on the right sections. If you're an individual, it's going to be on your Schedule E. Um, if you're doing a business return, it's a little bit different. It looks like a Schedule E, but it's a different form, but same format, right? But make sure you're getting your rental in the correct place. Now, we can have a whole discussion again about short term rentals and is it in Schedule E versus Schedule C, right? That's, again, another video. But if you're strictly a rental, make sure you're getting it on that Schedule E. Make sure you're listing everything out that form wants on there. Don't give the IRS any reason to come look at you. Do it the right way. fill out the form the right way. Neglecting state and local tax obligations. Oof, this one's rough for Floridians. Like, we don't understand this concept of state and local taxes, but some of you unfortunate souls out there that live in other states, or if you're a Floridian and you own a property in another state, you might not be thinking about the fact that you do need to file a return potentially in that state, right? And if you've got an LLC holding your property in another state, you might have obligations based on that in that state. So you really have to pay attention to what your filing requirements are. Ohio, oof, you're rough over there, Ohio. So many of your cities have tax obligations, which it kind of sucks, not gonna lie. But it's just something to be aware of. And of course, there's, the biggest city of all, New York City. Obviously, you got some filing obligations there, right? So you just need to be aware, especially if you're not used to filing state and local taxes like us Floridians. Just be aware of what you're getting into when you buy properties in other states, in other municipalities. Like, what are the requirements there? Because you might be surprised if you didn't take that into consideration when you were first getting into that property. And then failing to consider the tax effect of financing, right? So what a lot of times folks don't understand, and this goes for your primary residence too. This isn't just rental properties. If you've got a mortgage on your property, that entire mortgage payment is not deductible. It's only the interest. So a lot of times people will give me their rental expenses, and they'll show me like, oh, here's my mortgage payment every month. And I'm like, well, that's all fine and good for a cash flow analysis and from that perspective. But for your taxes, we only get to deduct the interest. So you have to think about that when you're analyzing different financing options and whatnot. And I know everyone's like bemoaning the interest rates right now, but in the overall history, they're not super high. Just in like the relatively short term history, they're higher than we'd like them to be if you're trying to buy property. But you do have to keep that in mind. You have to understand how that works. And the reason I say it's the same for your personal property, if you own your own home where you live, you also have that Schedule A deduction, right? So now we're getting out of the rentals, we're talking about primary residence, but that Schedule A deduction, it's also only applicable to interest, right? It's not the whole payment, it's just the interest. So those have been real low in the last couple of years. People haven't had big interest deductions, but now your mortgage payments might be a little bit bigger if you bought more recently, and so just that piece, that's the interest, that's the only part that you're going to be deducting. So it's something to keep in mind. Don't try to write off the whole thing. It's not all deductible. So we covered a lot. Like I said, real estate is no joke. The taxes are no joke. It's complicated. You need somebody who knows the ins and outs of things. And you have questions about your real estate taxes? No? You got it all figured out? I hope most people get it figured out. But if you've got questions, if you're thinking about buying, if you're trying to figure out what does it look like, what's it going to do to my taxes, we help clients with that kind of question all the time. So throw us a like, drop a comment, get in touch, schedule a meeting, and we'll see you next time.
Thank you for sticking around. I hope you learned something new. Please leave a comment, like, and subscribe to my channel if you want to continue improving your tax and financial literacy. Bye.